This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.crecentral.com to learn more. Welcome back to 30 Deals, 30 Days, where we are underwriting commercial real estate every day for 30 days so that you can learn how to go out and do this on your own. Today is day 16, and I don't know what we're going to be diving into yet because I don't prepare for any of these. I want you guys to see my reaction in real time as I'm seeing something for the first time, just like you will when you're going out there and you are finding some deals. Thank you guys for being patient with me. For whatever reason, when I came in this morning, my camera just would not turn on. So I restarted it. That didn't work. I had to actually shut my computer completely down, and then it just fixed itself. So technology, always fun. If you want to join the challenge, if you want to get access to my spreadsheets, my tools, the resources that we're using in here, if you want to get access to my course, The Beginner's Guide to Commercial Real Estate Investing, through the end of the challenge, go join it. You get free access to all of that. I just want you to learn how to underwrite because it's the number one question I get. It's like, how do I actually analyze deals? I don't actually think that that's the hardest part about commercial real estate. I think really securing financing can be the hardest part, even more so than raising equity, for sure. So go get the tools. I want you to be able to underwrite really, really, really well. All right, let's see what we're diving into today. So this is a deal from Jen, who is saying, hey, would love for you to underwrite this property. Well, let's see what it is. Let's get it underwritten. All right, so it looks like, okay, retail building in Miami. Looks like it's 7.55% cap rate, $4.5 million, $273 a foot, which doesn't sound unreasonable for retail, especially in Miami. I mean, I guess it depends on where it is. It's 100% leased. That's pretty interesting. All tenants are triple net, minimizing landlord expenses, diverse tenant mix. We like this. All right. This is interesting. 16,500 square foot center. 20 suites. I love that. That's good and bad. Some landlords will see that as a good thing, or some will see it as a bad thing. I actually see it as a good thing because they're smaller suites, right? I mean, every suite average is like 850 or 900 square feet. I like that. You know, you're diversifying your income. Yes, you're dealing with smaller tenants. We've got 20 of them. And those spaces, especially if you're not really, really good at leasing, like maybe this is your first deal, that's relatively easy for a new commercial real estate investor to get leased. As long as you market it correctly, you don't necessarily have to bring in some national, brokerage team to pull this one together. Looks like you've got 49 parking spaces built in 88. Concrete block construction. That's nice. You're going to need that in Miami, especially with how many more hurricanes, or I guess how much more intense hurricanes are getting. Let's see. Stable income stream. Always is triple net. That's one thing that we have to talk about with Florida is insurance rates. I mean, it's really difficult to even get a grasp as to what is going on with insurance in Florida and the coast specifically. I think with a lot of we'll have to find a way to account for that. I wonder what their insurance is or if we'll get to see that because that'll give us pretty good insight. But it's going up. That's for sure. It is going up. Law of Markets is saying, are there some cities you would completely stay away from retail in the Southeast? I mean, yes. I don't know that I could rattle them off the top of my head because they're going to be cities that you and I probably don't even know the names of. I think retail in any primary and secondary market in the southeastern United States, as long as you're buying it right, like it always depends on the specific deal. Like we can generalize about markets, we can generalize about asset classes, we can generalize about strategies, whatever. But you got to be careful with that because every deal is so hyper specifically dependent upon its own metrics, right? But as a whole, I would say no. There's not actually a city in the southeastern United States that I would specifically say don't ever buy retail there. I think that retail could be successful in any city. as long as you're buying it right? Because any city's going to have some component of retail, right? Even if it's just, where are we going and grocery shopping? Even if it's a, 300 person town, you're still going to have a grocery store, right? Okay, let's see here. Look at the flyer. I kind of like the colors. I know that really, it's very Miami, and I know that really kind of just is obnoxious, but hey, it grabs your attention. And you know what? If you want to have a very successful, small business oriented property, grab some attention. Look at this. This is one of my earlier projects here in East Nashville. Let me see if I can find some images of it. This is what it used to look like, right? See that old white and yellow, like nothing pretty. This is a rendering. So this isn't like the actual building, but this is pretty much what it turned out looking like. It's painted black on the side. We did corten steel facade. And then I did a copper sign that patinaed teal. Beautiful, right? And once we did this, we took it from 40% occupancy to over 90% within 2 years. Very, very quickly. And it had sat at 40% occupancy for 2 years before that, at least. So, little things like that grab people's attention as they're driving by can really, really make a difference. Let's see. Kevin is saying the roof is structural. Interesting. Yeah, it's, I don't know what's going on right here. That seems to me like, I don't know if I can, I can zoom in here. That looks to me almost like it was a canopy. I can't tell if this was an elevator shaft that might have come all the way up here at one time and they deleted that, or if maybe this was built to put the HVAC units in and kind of shelter them from the sun. Very interesting though. I don't know what that I don't know what that is. I don't think anybody's hanging out up there anymore. All right, let's get back out of here. Kevin is saying, how much CapEx was in that Dickerson Pike deal? Including, it's a 30,000 square foot building, 3 stories, including, interior common hallways and stuff like that. Probably $100,000. It wasn't much. We've spent more on building out individual tenant spaces than we did in the common areas. It wasn't much. If you think about it, like we had to paint the exterior. That's relatively cheap. That might have been $20,000, right? We had to, I actually, my studio's at that building. And so I ended up putting, oh my gosh, I tinted all the windows because I could not stand how hot it would get. So that was probably another 10 or 15,000. We put that corten steel facade on there. That was like including labor, probably under 20,000, and materials. So, really, really not expensive stuff. That's the nice thing about some of these like cosmetic upgrades is that you really don't have to spend that much money to make a substantial difference in how something looks. And then tenants feel different. Like think about that. Like if you were leasing space, would you want to lease here? I know it looks nice right there because it's got the sunset and it's a high quality picture. But come on, this was a POS. It was not a good building. This is a better picture of it. Somebody just like every now and then we will have somebody that drives into the building. I don't know how they do it. You can see there. I just wanted that whole sign ripped out. I was like, we don't need a retail sign for an office building. That looks ridiculous. Let's just make this look better. So, all right, let's see here. So, $4.5 million purchase price. Occupancy is 100%. Cap rate is 7.6. It's a very interesting shape. Why does it like that? Doesn't look normal to me. That doesn't look like a squared off rectangle. I wonder why. You don't always have to build buildings in rectangular forms, but it certainly helps. Okay, we have no leasing information. So we're going to have to make some massive assumptions there because we've got 20 leases. Let's see if this offer memorandum is... Yeah, I'm not going to do that because I'll probably violate something on this this confidentiality agreement like immediately just by live streaming this. So unfortunately, we're going to have to not do the offering memorandum. If I were you guys and I was actually underwriting this deal and I wasn't live on YouTube with all the evidence, I would download the offer memorandum. That'll give you a lot more information as to what's going on there. Okay, let's start throwing this one into the spreadsheet. So this one is Jen's deal. And we are in Miami, Florida. Okay, zoom in a little bit so you guys can see this better. So we said the property was 16 and a half. That's not what I wanted. It says approximately 16,000 here. It says 16,448. Let's go with 16,448. They're asking $4.5 million. Let's do zero capitalized rehab for now. Closing costs, we want that to be closer to 2%. So, what was that, 90 grand? And we'll come back up here to the capitalized rehab because I need to think through that for a second. All right, down payment, I feel comfortable at 25%. Guys, my loan terms, you've probably started to notice this every time I underwrite. They're relatively the same on every single deal because I generally know with the majority of lenders that I'm talking to today, if we come in with 25% down based on, our balance sheets, personal guarantees, size of the loan, whatever, we're probably going to be at 6 3/4 to 7 1/4 interest rate with a 20-year amortization. It's just, that's 9 times out of 10 where we'll be. As soon as it starts coming down below that, I'll start underwriting with lower interest rates. All right, so it's a 7.5% cap rate on $4.5 million. So that'll give us a total rent number. So $4.5 million times 0.0755 gives us an NOI of $339,750 divided by 16,448 gives us $20.66 a square foot on average. So $20.66. What we're averaging. Now, that could mean that we have some leases in there at $10 a foot and some at 30. And unfortunately, without digging into the offer memorandum, I'm not going to know how aggressively we can actually raise rents there. So we're probably just going to have to be a little more conservative on this. Z is saying Miami, Florida is about to get so crowded in the next 5 years. RIP New York City. Good morning. Good morning, Z. I actually doubt that. I think that people are going to be very happy in New York City. I'm excited to see what happens. All right, let's see. 3% annual increases. We will keep that. We're already at 100% occupancy. So I'm going to basically maintain 7%. The reason that I'm doing that is because we're never going to be, you should never really be at 100%. You should always have like a little bit of turnover, right? Because if we have some leases that we're trying to turn over that are below market, we want to get them up to market, we're going to have some turnover. So even though we're 100% occupied today, I'm just going to say we're going to average 7% vacancy. And if we run the math on that, so we said 16,448 square feet times 0.07. That's 1,151 square feet. That's basically saying at any given time, we have one suite available for lease. Not bad out of 20, right? All right, let's see here. We'll keep it at 6% commissions. Why? This is why you should always download a brand new spreadsheet every time you do a deal. I've been using the same one, and I'm looking at this. I'm like, we're not paying $100,000 in commissions. Something is broken. Em is saying, good morning from Long Island, New York. Good morning, Em. Great to have you here. Thanks for joining us. I'm actually going to, let's see why this is broken. C54. So if you guys ever want to diagnose why something isn't working properly, just double click on it. Look at the formula. It's going to highlight these boxes. All right. So we got C54 times Z61, which is our 5-year total on the rents, times 1 minus V56. Okay. So what it's saying right now, and this is set up because this spreadsheet is actually more for value add than it is for stabilized projects. What it's saying is we're assuming a 100% occupancy minus 7%, which is saying that we're leasing up 93% of the building. So what I'm going to do to get around that for now is I'm actually going to zero this out, and I'm just going to say, because if we're leasing any one suite every year, 1,150 square feet at, let's just call it $20 a foot. Let's just do the math. 1,150 times $20 a foot. It's $23,000 a year in rent times 5. These are small spaces. We're probably only going to be signing 1-year leases. Let's just multiply that times 6%. It's $1,380. So let's just say we're spending $2,000 a year on. We're probably going to end up spending a little bit more than that, but you can pay for it out of cash flow. So I'm just going to keep this for where it is for now. I'm going to mark all of these as red so that I know that I have destroyed that formula. Alrighty then. With it being all triple net, you're still going to have asset level expenses. So what I would say is keep the 50 cents a foot in there. Theoretically, you could just zero that out and say, well, I don't have any operating expenses. Yeah, you're not going to have any technical operating expenses on the property. But I always like to keep 50 cents a foot in there, give or take, depending on the size of the project or what actually has to be done. Because we're probably going to have $8,000 in expenses. If I've got investors in this deal, and I've got to pay a CPA to put together all the K1s and send those out, we're probably spending that, right? So it's just good to have that baked in there. All right. And we don't ever hit our debt service coverage ratio. Now, keep in mind, this was bringing zero money to the table, and we're just increasing rents by 3% per year. So it's basically saying, let's just maintain the status quo. All right. So if I come in here and I say, well, I'm raising capital for it, so I need a 2% asset management fee, we should I zeroed out my capital reserves. Okay, that equals 0.35 times. That's why you got to always mark it in red, even I forget. So 35 cents a square foot a year gives us $5,700 a year just to hold back in case an HVAC unit goes out. Or we could spend it on tenant improvements, whatever we want to do, right? Say we're taking 30% because we're raising capital for it. Oof, not too excited about this, right? We're losing a little bit of money the first couple of years. Typically expected in a turnaround. This isn't a heavy turnaround, though. And then if they're asking a 7.55% cap rate today, I would expect a 7.5 cap rate on the exit. 5% cash-on-cash returns, right? So Kevin is saying go lower on the asking price for sure. Check the days on market. Let's see what we've got. This is a problem with LoopNet. I can never really tell. I think it's at the bottom, maybe. Yeah, date on market was August of 25. So it's only been on there for a couple months. So not super long, but I do think that the price is too high. The problem is we don't know what the leases are, right? So we could have some leases that are severely under market. Well, if I'm able to come in here and start turning all of those over in year one, let's say I'm able to average a 5% annual increase. Oh, sorry, that's on the expenses. I'm going to keep that at 3. Able to get a 5% increase every year on my rent, then the numbers start to really change, right? Now we're at 23%. Still not great. I can't make that work, right? I'm not going to get out of bed to make 23% on my money for the next 5 years. I'll just put it in treasury bonds. So at that point, you got to start looking at it and go, okay, well, it's probably, I mean, what does it look like if we're at 4,250? Keep in mind, we're not even bringing any CapEx budget, right? So we're still at 40%. So it's basically an 8% average cash on cash return per year. Kevin is saying, can't we check for comps? Yeah, we can, but it's not going to make a difference in the underwriting. I mean, the comps would have to be substantially lower. I mean, it's offered at a cap rate, right? And so, like, even if everything on a price per square foot is different, this has, tenants in it that are relatively stabilized. Now, what I would say, and we'll look at comps here in a minute, is that it's a 7.5% cap rate, but these could be high risk. I mean, these are high risk tenants. They could be shorter term leases. That 7.5% cap rate's probably a little too aggressive. But let's go look at some comps. We're going to look in the 3 million. Oh, not 300,000. $3 million to $6 million range. And what filters do we have? We just want to look at retail. All right. Here's a 6% cap rate, but that looks like it's a single tenant building. Look at that road name, Pinch a Penny Bird Road. Whoever did that was like, man, whoever's got I just want to mess with people that have to address letters for the next 300 years. 5.8% on an apartment building. Why is it showing me apartments? Don't want restaurants. Let's say we want triple net. I don't want auctions or pending sales. I want multiple tenancy. Let's just dial this in even more. We don't want to include portfolios. We don't want to include condos. We don't want to include businesses for sale. Oh, come on. You can't even exclude business for sale? Look at that. Drops it pretty rapidly to just this one and one other property. Let's remove the boundary and look at this whole area. Nothing. Okay, let's expand our price range. 2 million up to 8 million. The problem is once you start getting into these price ranges, you're going to see substantially different just types of deals and different types of cap rates. All right, 7.13% cap rate on 7,500 feet. I mean, none of these are really comps. So what I would have to do if I wanted to truly comp this, I'd have to start calling brokers in the area and just try to figure out what's recently sold. You can also look in the local business journals for comps. They're not going to like just announcements of sales. They're not going to give you the cap rate that things sell for. So that's the problem there. I mean, even if I bring 100% cash, if we get it for 4.25, it still only ends up being a 35% cash on cash return. Like, I just don't see how the numbers work on this deal, unfortunately. You'll get a 5 to 6% return. So maybe if you're in a 1031 exchange, you've got a lot of money, you just need to place somewhere and you don't want to pay taxes on it. This would be a fine deal. The problem is with interest rates being at 6.75% and this being a 7.5% cap rate deal without a lot of value add, like meat on the bone. The nice thing about these shorter term, I mean, maybe they're shorter term. We could have 16 or 20 tenants that are all signed at 5-year leases with 3% annual increases. We don't know, unfortunately. But I mean, look at it. Even if I drop it, I would probably have to drop this down to 3,750,000 to make this make any sense. Yeah, there you go. Now it starts to work. You'd have to get it for $3,750,000 for that to start working. Kevin's asking about interest only. Are you saying like IO for the first 6 months or 12 months? You might be able to find a lender that would be willing to give you an interest only period, but it's stabilized. I mean, we're only talking about a $75,000 difference, right? Even if we get 12 months of IO. So let's just drop that down to 0. Mark this red so we don't forget. $51.14%. That's at $4,250,000. We're bringing no capitalized rehab. 5% annual increases on the rent. We miss 1 year of principal payments, so $75,000. You get a decent cash boost that first year. Still 5% though, and you're still only making 51% on your money over 5 years. So it still wouldn't be worth it to me. I mean, maybe if you could get the IO period, then you could drop your offer down to $4 million instead of or raise it to $4 million instead of $3,750,000. And now I still wouldn't do that deal. 71.92% return on your cash. I mean, it's a 14% annualized cash on cash return, right? So think about that. Like, I mean, my stocks are returning me higher than that right now. I'm not getting write-offs. It's not a tangible asset. It's not secure. I can't control it. But 14%. I don't know that I'm going to do all that work to deal with this. I might, if I've got a 1031 exchange. So there you have it. I mean, that's why it's, when I tell you guys, like, go for the value add deals, find something that has some sort of substantial upside potential, right? When you're 100% occupied, you're paying the seller for having gotten that property to 100% occupancy, right? Which means you're paying a premium for it. I would rather look at that property and it be 80% occupied, because then I'm paying less. Yeah, my cash flow is less. Who cares? I'm just going to go lease it up, get aggressive on that front, add some value to it, and then that's where I'm going to create my spread. So don't get tempted by these like relatively stabilized looking properties unless you're just willing to accept lower returns, because that's what you would have to do. So awesome. All right, guys. Thank you for joining me for day 16 of 30 Deals in 30 Days. We will be back at it tomorrow with day 17. As always, join the challenge, CREcentral.com/30deals30days. I'll see y'all then. This episode of the Commercial Real Estate Investor Podcast is brought to you by my CRE Accelerator Mastermind, where you'll get access to my step-by-step investment blueprint, essentially a library of resources on how to invest in commercial real estate. You'll get connected to a supportive community of other commercial real estate investors that are doing projects just like you. You'll get personalized coaching and feedback from me every step of the way. Go to www.CREcentral.com to learn more.